Negative gearing. Is it still a great investment strategy? Well, in this webinar, I'm going to work through a long example of negative gearing to answer some important questions and to bring out what's most essential for you to get right for your negative gearing strategy to deliver high returns in the long run. Here's our questions. What returns should you expect from negative gearing in the long run? Well, after inflation and after tax, between 6 and 10%. Now, a 6% return will double your money every 12 years, but a 10% return will double it every 7 years. Now, I'll also assume that you're using equity from your home, and I'll make some other modest but very realistic assumptions. Now, what are the key drivers of high returns? Well, maintaining leverage throughout your strategy, getting a high real price growth in the underlying house, and low real interest rates. The first two of those you can influence strongly. The third one you can't, but I'm going to explain them all as we go through. So what are the biggest mistakes investors make? Not positioning for growth, but instead positioning for yield in their negative gearing strategy. And also not having a strategy to maintain high leverage right from the start. And finally, I'm going to make a comparison between using after-tax money to either put it into super or to gift it into a family trust and invest it, or put it into negative gearing. And what we're going to see is that negative gearing delivers higher returns than super or family trusts on average, but with more risk, more effort, and it's harder to scale. So for most investors, a combination of money into super, a family trust, or a negative gearing, some combination of one or two or three of those three things is going to be the best strategy. 2 seconds on me, since this is a webinar. I've been an academic for a long time. I studied engineering at the University of Western Australia. I went to Canberra to work for the federal government and did a master's degree in economics at that time. Then I went to the London Business School at the University of London and did my PhD in investments and wealth management. Went to Dartmouth University in the States for 7 years as a junior professor with my wife, Tracy. And then we came home in 2004 and I went to the University of Melbourne, where I've been since then. So I was an academic for a long time, but some time ago, I started doing quite a lot of consulting. That's normal for business school academics. And consulted to a lot of corporates. Nowadays, I work mostly with wealthy families and family offices in my consulting, but I still work for Australian Super a lot. I used to do a lot of media, but now I have a YouTube channel, of course, and so it's all digital media for me now. Okay, so just quickly here, this is education and not financial advice. You know, we need to say that. Now I want to talk about competing uses of your money and just set up a few ideas before we get into our long example on negative gearing, where we're going to bring out so many important ideas. But this idea is very important too. So you need to carry your money into the future in some vehicle, in some structure. And so you could do that by building up equity in your family home, and that's a common part at the beginning of people's investment journey. By putting money into concessional super, that of course is compulsory. 11.5% of your salary has to go into super from your employer, up to $30,000 per year. Non-concessional after-tax contributions, you can make up to $120,000 per year. And then negatively gearing a property is another possibility. Putting money, gifting money or lending money into a family trust and then investing it in shares or property or something else is another possibility. And building up a business is another possibility. Now, the reason that I color these in this way is that early in people's investment journeys, these two things are usually competing for their money. Extra contributions, pre-tax contributions to super versus paying down their home equity. And rather too many people concentrate on this at the expense of this. Now, later in people's investment journeys, once they've paid down their home mortgage to a comfortable extent and they are maxing out their super, then it becomes this. These three things, putting money into super, into a negative gearing strategy, into a family trust, are really competing with each other. Now, we're going to concentrate on negative gearing here, but we are going to be thinking about the comparison of negative gearing to these other two possibilities. So next we need to talk about returns. And what we're concerned with is real after-tax returns. So real means after inflation. So we're going to take inflation out of our returns. And then we want after-tax returns. So we're really concerned with how much spending power you have and how quickly your spending power on real things grows. Now, obviously, inflation doesn't help, so we need to take that out. And then we want it to be after tax so that it's money in your pocket. Now, if you put money into non-concessional super, into and this is super after tax that we were talking about just a moment ago, you should expect to get about inflation plus 5%. You should expect to get, let's say that inflation is 2.5%, and let's say that the return on your super is 8.5%. That'd be a typical figure in the long term for one of the best super funds. Then you're going to pay about 10% tax in the combination of negative gearing and income tax in your super as it accumulates. So we start off with 8.5%, take out 10% tax, take out inflation of 2.5%, and we'll have real growth after tax of about 5%. Now, if you invest in shares in a family trust, depending upon your particular circumstances, you'll get more like inflation plus 6 to 8%. So what return after tax and after inflation should you expect from your negative gearing strategy? Well, that's what we want to work out in the example that we're coming to. Now, just before we do that, let's think about how long it takes to double your money. That's what we're really interested in here. What do these returns mean in terms of how long it takes to double your money? So you got 100K, how long does it take to double that? Well, the years to doubling your money depends upon your return, obviously, and the higher the return, the shorter the period to double your money. And here's what we have, that if you get a 10% return, it'll take 7.2 years of compounding at 10% to double your money. And if you have a 9% return, it'll take 8 years, and 8% return, it'll take 9 years. Now you can probably see a pattern here. And the pattern is that these all multiply to 72. 10% takes 7.2 years, 9% takes 8 years, 8% takes 9 years, 7% takes 10.2 years, etc. And eventually our rule breaks down. But this is referred to as the rule of 72. Just keep the 72 in the back of your mind. How long does it take for 6 years? How long does it take for an investment earning 6% to double my money? Well, 6 into 72, it's 12 years approximately. But it's a very good approximation. This is a really handy rule. Now, the next thing we're going to do is go through a long example with Tom and Mithra. So we're going to look at their investment journey, and we're going to bring out some important points, and we're going to see where negative gearing fits against competing strategies. I think you'll find this quite helpful. And then we're going to look at them investing in a negative gearing investment property and see what types of returns they will get when we change our assumptions. This will really bring some things out for you, I think. Even people who have been enacting or running their own negative gearing strategies for long periods of time, there's plenty of things that they don't know about negative gearing. And I think that'll come out for you in this example. So here's Tom and Mithra. My wife Tracy thinks that Tom's a bit too old for Mithra, but nonetheless, here they are. And they are in their early 30s, and they are saving for a home. And so one is earning 110K and the other's earning 90K, and they also get super on top of that. They're on the 32% tax rate. Now they're each saving 20K a year, 10K by putting extra money into super and using the First Home Super Saver Scheme. If you don't know what the First Home Super Saver Scheme is, then just have a look on my YouTube channel, search for Sam Wylie and First Home Super Saver Scheme. And then they're saving 10K outside of super. So here they are. Let's give ourselves a white background here. And let's think about the flow of their money. So they've got their salary and any investment income from shares or property or anything flowing in here. These are their combined salaries. And then out here is their spending. And everything that's flowing in that doesn't flow out as spending is either saving or it's tax. Saving or tax. Now, they need to make super contributions, 11.5%, as we said before. And the federal government wants 15% of those super contributions, unless your taxable income is above 250K, in which case they want 30%. And then the money's going into their super. And they're making big contributions, extra contributions, because they want to use the First Home Super Saver Scheme. They're going to take some of this money out for their first home in just a moment. And that scheme is terrific. As I said, if you're saving for your first home, or your children are saving for their first home, and you don't know what the First Home Super Saver Scheme is, then you've got to look it up. Have a look at my video on YouTube. Okay, now it's going to be very important for us to make a distinction before tax and after tax, because this distinction is crucial in understanding negative gearing. Before tax money is less valuable than after tax money. This is the First Home Super Saver Scheme. And so they are saving down here for their first home, and they're also saving up here. Before tax, after tax. Now they buy their home and notice that money has come out of their super. You're allowed to take up to 50K of money out of your super if you've made extra contributions. You make extra contributions above the compulsory contributions, you can take that money out even after it's compounded and use it for your first home. So they take 100K out of here and 100K here, and that's the equity to buy their first home. And so they buy a house for $1 million, and then things move along a little bit. They pay down their debt a bit, increase their equity by paying down their debt a bit, and the value of the house goes up. And now their house is worth 1.2 million, and they have 500K in equity because they paid down their debt a bit. So they've got 500K in equity here. And then they decide to use that 500K in equity to invest in a property. We'll come to that in just a second. But actually, just before I come to that, I should note that they move along a little bit more. Before they buy an investment property, they buy a nicer house. So they upgrade to a house worth $2 million, and now they've got more debt, but no extra equity, but more debt because they've upgraded their house, and now they're concentrating on paying down their debt. They've got quite a lot of debt. They want to get to a comfortable position with their debt. But this is the tension that I referred to earlier. This tension between using your cash here and putting it into super, maximizing pre-tax contributions, Tom and Mithra maximizing their pre-tax concessional, because it's pre-tax, contributions to super, as opposed to paying down their mortgage. Now they can use $10,000 and put it in here, or they can pay tax and they'll have $6,800 and pay down their debt, increase their equity by paying off the principal on their mortgage. Which of those two things is better? Well, this is a really important tension here. And it'll depend on the individual circumstances. But in general, too many people concentrate on repaying their mortgages at the expense of this very beneficial pre-tax contributions to super. This is really terrific. And for most investors, once they get a comfortable level with their debt, then they're going to want to max out their concessional super. Okay, so now they do invest in a rental property, and they're using they're making contributions into the rental property. They have a negative gearing strategy, which of course means that the interest payments exceed the net rent on the property. And we're going to work through a very detailed example here to bring that idea out completely, but they're putting money into their negative gearing strategy, money that would otherwise have flowed down here. And they could have used for some other purpose, to pay off their home mortgage, and we'll see the other purposes in just a moment. But they're putting money in here. And to the extent that money's coming out here, less money is going in here, and there's less money down here. So less money going to the government and less after-tax money. If $40,000 is flowing out here, that's going to happen in our example in just a moment, because they're going to have a net interest, their net rental yield will be 1.5%, and their interest payments are going to be 5.5%. And so 4% of $1 million, they're going to borrow all the money, 4% of $1 million, $40,000 is going to be going down here. And that means that there'll be less money down here, and that they'll have less money, they'll be paying less tax, and they'll have less money down here. Okay, now, what could they do instead of enacting this negative gearing strategy? Well, they could put money into non-concessional super. Instead of sending the money out here, they could let it flow down here, pay tax, and then contribute it to their super. And there's plenty to be said for doing that. Another possibility, of course, is that they could gift the money into a family trust. They could set up a family trust, and they could gift the money into a family trust. And here are the beneficiaries, Mithra and Tom, and their children. And they've also got a bucket company. What that bucket company means, how these family trusts are set up, that's really a subject for my investments course. Now, family trusts, let's just talk about that for 1 minute here. What's great about family trusts is that when money starts coming out of the investments in a family trust, then there's discretion over who that income or capital gains, the money, the returns on the investment. Let's say that money's put into the family trust and is invested in property or in shares. Once money starts coming out as income or capital gains, then the trust can distribute it to any of the beneficiaries, to Mithra, to Tom, to the children, to the bucket company, or to other people, to other family members, to parents, etc. And so there's discretion across the beneficiaries, and there's also discretion through time. It's the storing of the money in the bucket that gives them discretion through time. If there's no one to distribute the money to today, then we can store it in the bucket and distribute later on. So discretion across beneficiaries and through time is the main tax benefit of family trust. Now, there's other benefits from family trust, such as asset protection and estate planning, but that's the main tax benefit, and it's terrifically helpful for that purpose. So our negative gearing strategy is competing with contributions to super and to the family trust. Now, let me just note again that they have borrowed all the money here, as I said earlier. They haven't put any equity in here. And so what have they got in terms of a loan to valuation ratio? They use the equity in their home. So we've moved on a few years now, and the $2 million home that they bought has moved up to $2.2 million, and they paid down their debt a bit. So now they've got $800K of equity. The total value of their portfolio, it's rather grand to call a home and an investment property a portfolio, but let's call it that. The total value of their portfolio is the 2.2 plus the 1, so 3.2 million. And they've got equity of 800,000 and debt of 2.4. So their total loan to valuation ratio is 2.4 million over 3.2 million, so 75%. So not so bad. They had a lot of equity in their home, and they used that to finance their investment property without putting any new equity in. Okay, so now the next thing for us to note is that what the cash flows look like. So we're going to be assuming that they buy the house here today, the investment property, and they sell it in 24 years' time. And they're putting money into their negative gearing strategy, and then eventually they're taking out a big capital gain when they sell the property. It's gone up a lot in value with inflation and with real house gains over time, but they're putting money in and eventually taking a lot of money out. And they're putting the money in here. So let's say in the first year they're putting 40,000 in because there's 15,000 of net rent, net meaning after the rent net of all the outgoings, like having an agent, like land tax, like interest, like rates, etc. So they have a net rent of 15,000. The interest payments are 55,000. So they're putting 40,000 in here to support it. Now, what we're interested in the next diagram is not the cash flows up here, but the cash flows down here. This is all after tax. After-tax income that's being used up in the investment strategy, and then after-tax capital gains that are received when the property is sold. So it's all after tax. So it's not the 40,000 that we're interested in. It's the 40,000 after tax that's being taken out. That's the after-tax cash that's being used up. Cash that could have been used to pay down debt, to put into super, to gift into a family trust. This is the cash that's being used, after-tax cash that's being used here, instead of being used in something else. That's what's important to us. And then, of course, the gain that we have has to be after tax as well. That's a crucial thing to understand that distinction. Now we're going to work through our example. So their example of Tom and Mithra buying the $1 million property, and all the way through, and I'm actually going to use the 24-year example, and I'm going to do it in a spreadsheet, but I'll show you each row of the spreadsheet as we go through, and I'll explain every row in the spreadsheet. You could create this spreadsheet for yourself, of course. So here are the years of the investment. So Tom and Mithra buy the property here, year 0, that's today, all the way through to when they sell the property in 24 years' time. Now here's the value of the property. They buy it for $1 million. We'll worry about stamp duty in just a moment. And then it increases in value by 5% per year. And 24 years of compounding at 5% takes it to 3.225 million in 24 years' time. This was the price. Here's the growth rate. The 5% growth rate is 2.5% inflation and 2.5% real price growth rate. Now we're going to look at whether that's a realistic assumption in just a moment, but we'll see that that's actually a very modest assumption. And let's go forward. So our loan to valuation ratio, to begin with, it's 1. We're going to borrow all of the money. using equity in Tom and Mithra's home to support the mortgage, as we saw just a moment ago. And the combination of their home and the property will be an LVR of 75%, but just the property by itself starts with the loan to valuation ratio. They're going to borrow of 100%, going to borrow all the money. As we can see here, $1 million of debt. They could have potentially borrowed all the money for the stamp duty as well, but we'll just come to that. And so $1 million of debt all the way through, no rebalancing yet. And then, so this is the LVR and the debt. And then their equity, this is just simple arithmetic. The difference between the value of the house and the debt is their equity, 2.25 million, 2.225 million down here. Now their net rental yield, 1.5%. So the rent is 1.5% of the value of the property. The rent, the net part, is the rent after all the outgoings. That includes agent fees and insurance and land tax and rates and sometimes water, etc. And so after those outgoings, their net rent, 1.5% of the value of the property. Now, some of you will say, well, where do you get that from, Sam? Well, just from experience. This is $1 million property. So let's say the gross rent was something like 2.7%, $27,000 per year, $550 per week on this $1 million property. And then with the outgoings, we get down to the net rent of 1.5%. Now, the size of the land tax, which is such an issue for people at the moment, for investors at the moment, especially in Victoria, will affect this. And we'll see that if the land tax goes up, then the net rental yield will go down, and we'll see what the sensitivity of the net rental yield to the total return on the property or on the investment strategy for Tom and Mithra is in just a moment. But the next thing we need, so this is the net rent. Next thing we need is the interest payments. So we're assuming that the mortgage interest rate is 5.5% here. Where do we get that from? Inflation plus a real interest rate. So the combination of these two things is the cash rate, the RBA's cash rate, and then a bank margin of 2% on top of that. Now you might say, well, the cash rate's more than 3.5% at the moment, and that's correct. But we don't want to use the cash rate today when we're thinking about the whole of the 24 years of the investment strategy. We want what we think is going to be the average mortgage interest rate to work out what our return is going to be. So interest rates are high at the moment because inflation's high at the moment, but inflation will go back down into the RBA's target range of 2 to 3%, and we're choosing here the midpoint of that. Within a year or so, it'll be back into the target range, and it'll stay there. Sometimes it'll be lower, sometimes it'll be higher over the complete journey of the 24 years of the investment. So we're making an assumption here what we expect the mortgage interest rate to be over the whole journey. Inflation plus 1%, that's the cash rate, and then a bank margin above that. Now, if this was a home loan instead of an investment property loan, then it would be principal and interest. But because it's an investment property loan, it's going to be interest only. And so if it was a home loan and principal and interest, then we might expect that the bank's margin would be 1.8%, 180 basis points above the cash rate. That's about what it is. You might get a deal that's a little bit better than that, or maybe a bit worse if you don't negotiate properly or go to a good mortgage broker, etc. But with an investment property, it's going to be a bit more because the investment property is going to be interest only. You know, why would you want to have a principal and interest loan for an investment property? That's almost never the right strategy. We'll see as we go along here how important it is to maintain leverage in negative gearing. And paying down the principal, having a principal and interest loan on an investment property is reducing the leverage, reducing the loan to valuation ratio, the amount of borrowing. You don't want to do that. There's hardly ever a good reason to have a principal and interest loan for an investment property. Interest only. And that's what Tom and Mithra have here. But because it's an investment property and because it's interest only, it's going to be deemed to be more risky. Banks have to hold more capital. They're going to charge a bit more. So we're assuming here that they're charging 2% above the cash rate. So here we are, 5.5% down here. And so interest of 5.5% on the debt, $55,000 over the life of the debt. And okay, and then now here we have our before tax loss. So the 15,000 minus the 55. So before tax loss of 40,000. And the before tax loss is going down, of course, because the interest payments are not changing because the debt's not changing. in our example, but the net rent is going up because the value of the property is going up. And so the loss on our investment strategy is going down here. Now, we're not really interested in the before-tax loss. It's the after-tax loss. It's how much after-tax cash is being chewed up. Remember, we saw this before. This is the 40,000. Let's just go back to that for a second. 40,000 is going out here to support the negative gearing strategy. And Tom and Mithra are now on the 47% tax rate because we moved along quite a few years and their income's quite a bit higher. So of that 40,000, if instead of the 40,000 going here, we allowed it to flow down here and then to go in here or to pay down their mortgage, instead of 40,000 being used in the negative gearing strategy, it flowed down here, it'd only be 21,000 because 19,000 would go out here to the government. And so putting 40,000 in here means 21,000 less of after-tax cash. And that's what we have here. It's after-tax cash that we're really interested in. 21,000 less of after-tax cash. That's what we care about. Now, the remaining parts are the money that we put in, the capital that we put in and that we take out. Now, they didn't put any money in originally except for paying the stamp duty. I'm assuming here the stamp duty is 5.5%, and they pay the stamp duty on this property. They put that money in. Maybe they could have borrowed part or all of that, but I just ignored that in the example. So they had to put 55,000 in from after-tax money. They're putting after-tax money in to support the negative gearing strategy, and eventually they are taking the capital gain out. So the capital gain is 2.25 million. And then they have to pay capital gains, 47% divided by 2. The capital gain will be split in 2, and then they'll pay for it and then be added to their income tax. Or we can just think of it as the capital gain being taxed at half of their income tax, 23.5%. So they'll pay 23.5% on this, which gives us this amount here. And in the last year, they lost 5,000 on supporting the negative gearing strategy. So 1.697 million is what they're taking out. Now, if they put all of this money in and they take that big sum out, what has been their real return? Well, their return has been 8.9%. Once we take inflation of 2.5 out, they've had a real after-tax return of 6.4%. Now, remember that 6.4% return, or remember the rule of 72. So 6.4% times 11 years gives us 72. And so at 6.4%, their after-tax money will double every 11 years. So this is giving them a doubling of their money, the money they can actually spend in real terms, adjusted for inflation and after tax, every 11 years. So that's good, right? It's better than what we were looking at with super, as good as what we look at with the bottom of the range with family trusts. So it's good already, but it can be a lot better. And especially it can be better if they refinance to get the loan to valuation ratio higher. That's what they haven't done. They've allowed the loan to valuation ratio to fall as the value of the property has gone up. Now let's assume that they refinance after 12 years, that they take it back up, and they do that by increasing the debt. And when they increase the debt, they can take the equity, increasing the debt, the property is the same value. When they increase the debt, then they're reducing the equity because they're taking the equity somewhere else. They're going to take the equity and use it to purchase another property. Or they might do something else. They might use the equity to borrow money and lend that money into their family trust. That's something we would talk about on my investment course, for instance. But in any case, they're using the equity somewhere else. Now, I'm assuming, this is an assumption, this is not what would really happen, this is a stylized assumption. I'm assuming that that equity that they take out, that they pay tax on it, and they have it in their hand today. Now, that's not what really happens. There's no realization of the capital gain because nothing's being sold. But it's a simplifying assumption. Otherwise, what we'd have to do is if after 12 years, Tom and Mithra buy another property, we'd have to consider both properties to get to their return. So that we can just continue to only consider one property and keep it simple, I'm going to assume that they pay the capital gains tax here. Now, actually, they pay the capital gains tax down here. And paying capital gains tax early is understating the return that they would earn. So this is just a simplifying assumption that when they take the equity out, they pay the tax on taking the equity out. That's not what really happens. They would take the equity out to use it somewhere else, probably in buying another property. But anyway, it's a simplifying assumption. So now they've taken some money out here and down here. But the main thing to note here is that when they refinance and reestablish their leverage at a higher level, then their real return goes way up. This is much higher than the 6.4%. This is doubling every 8.8 years, not every 11 years. So why don't they refinance at a higher frequency? Let's say that they refinanced every 6 years and took some equity out. Then what would their real return be? It would be 9.9%. So this is doubling every 7 years, the value of their money. Now, you can really see the importance here of maintaining leverage, of refinancing to maintain leverage in your investment portfolio. And so we go from no refinancing and a return of 6.4% to refinancing every 6 years and a return of 9.9%. We go from the money doubling every 11 years, that's with no refinancing, to a doubling every 7 years, that's refinancing every 6 years. So let's say that it's a 22-year investment. So doubling every 11 years means that they've got 4 times the money that they put in. And if they're doubling every 7 years, then they've got 8 times the money that they put in. It's twice as good in that respect. So you can really see how important maintaining leverage is. This is probably the biggest mistake people make in negative gearing, is not having a strategy right from the outset to maintain that leverage. Okay, now let me just talk for a moment about my Finance Education for Investors course. I run this twice a year. It's coming up on the 7th of October. It's about empowerment and getting to better outcomes. It costs $1,400 plus GST, but the course goes for 10 weeks. And look, a lot of people make 100 times this in terms of how much extra wealth they have by the time that they retire. So it's a great return on your investment. It's first of all about empowerment. A lot of investors feel like there's something big they don't know about investing, and that feeling goes away in the course because we cover everything. And then they don't know how to get rolling. They don't know how to get traction on a good investment strategy. And we take you through a 10-step process of putting in place a proper investment process and investment strategy. So we do it week by week. You work through the 10 steps week by week. And then, of course, people feel like they don't know who to trust. And we work through that as well, showing you how to negotiate with and to think about accountants, about financial advisors, about mortgage brokers, etc. And then the second goal is to get you to better outcomes, to get higher returns, to reach your financial goals more quickly. So investment process, knowledge, guided self-examination. People find it extremely helpful. Over 2,000 people have taken the course and had a great experience. Now, it's taught live, the course, 10 live classes starting on the 7th of October, 10 Monday nights from 7 to 9 p.m. So the classes are live, but they're on demand as well. So you can come to the live classes, or you can watch them on demand at your discretion, or you can do both. And a lot of people do both, one or the other, but many do both. And so you have all of the videos, you have all of the pages of content, and one-on-one discussions with me. About half of the participants choose to talk about working through their workbooks with me in a one-on-one session. So go to windlestone.com for more information or to enroll. And if you're watching this video sometime in the future, and this is no longer the current course, then you can always go to windlestone.com and enroll in the current course and find the current information. So what I want to do next is now that we've set up our model, we want to see what happens if we change our assumptions. What happens if we change our assumptions about inflation, or about real price growth, or about the real interest rate, or about the net yield because more land tax comes in, for instance. So people don't have good intuition about these assumptions. And what are the really important things to get right in negative gearing? We've already seen that it's really essential to get your refinancing right, and that's hugely important for a negative gearing strategy, that you need to maintain your leverage and to think through that right from the very beginning. Even before Tom and Mithra buy the property, they need to think, if I'm going into negative gearing, I've got to maintain my leverage through time and refinance. How am I actually going to do that as a practical matter? Okay, so in our model, we're going to change the rate of inflation. And so if we just go back here for a second, we can see that the inflation rate is an assumption that feeds into the growth of the value of the house. And so it's that assumption that we're going to change. What happens with negative gearing if the inflation rate is higher or lower? Now, most people have the intuition that inflation will be bad, but actually inflation is good for negative gearing. Higher levels of inflation deliver higher returns, higher real after-tax returns. And it's because negative gearing is a process of turning pre-tax income into after-tax capital gains. Now, ideally, the capital gains would be real capital gains, real growth, but just inflation will do. And most people don't have good intuition about that. They don't realize that negative gearing works better during periods of inflation, over long periods of time, and not worse. Higher returns. Now, if you were a negative gearing investor through the 1970s and 80s, you would have seen that. You wouldn't have had a lot of real price growth, but you would have had a lot of inflation, and your negative gearing strategy would have still worked. So that's one thing. Now let's think about real price growth. I want to go to this. This assumption about house prices, or the value of Tom and Mithra's investment property, growing year on year on average faster than inflation by 2.5%. So let's look at that assumption and just go back here for this graph for that purpose. So these are real house prices in Australia, the growth in real house prices in Australia. And over 54 years since 1970, from the beginning of 1970 through to the beginning of 2024, those 54 years, 2.7% average growth. Now, the growth has been higher in the last 30 years, but even over the last 54 years, it's averaged 2.7. Now, we're only assuming 2.5. And there's something else, that that 2.7% includes apartments, which have a lot of yield but not much growth. And it also includes regional properties in places like Ballarat or Port Macquarie or Rockhampton, etc. So it includes apartments, regional properties, outer suburb properties. All of those don't grow as quickly. And all of those have more yield and less growth. And the reason they have less growth is that they're easier to replicate. And I'll come back to that in just a minute. But what we can see here is that our assumption of 2.5% is a modest one, because for houses in leafy suburbs, or established houses, let's say, as opposed to new houses, and certainly as opposed to apartments or regional properties, Tom and Mithra's house is going to have a higher expected return than them. And so, those houses grew a lot faster than 2.7% over the last 54 years, but we're only assuming a growth rate of 2.5%. Now, what if the growth rate was higher or lower? Well, it's going to have a big effect here. If it's higher, then their money will be doubling every 5 years and not every 7 years. If it's lower, their money will be doubling every 14 years as opposed to every 15 years. But this is a modest assumption, and we can see high returns even with a modest assumption. But it also shows you that you've got to go where there's growth. Negative gearing is a growth strategy, and you've got to find growth. Let's talk about that some more in just a minute. What else should we think about? Well, the loan to valuation ratio. What if they had to put money in at the beginning? Now, I was assuming that they could use the equity in their portfolio, but what if they chose to go straight to a negative gearing strategy? What if Tom and Mithra, instead of choosing to buy a home, build up the equity, then go to a investment property, what if they lived with the parents of one of the couple, and decided to rent vest? Rent vest is kind of a dumb expression, but it means investing while renting or while living with parents or something. What if they chose to do that? And they went straight to an investment property before they invested in their principal place of residence, their home. Well, in that case, they'd have to put some equity in. And here we want to see what the effect that will have on their return. And of course, it'll reduce it. If they had to put in, instead of being able to borrow all the money, they could only borrow 85% of the money, and they had to put $150,000 of their own money into the investment. Then because they're putting more money in and they're getting the same amount of money out at the end in this strategy, then the return is going to be lower. And here we can see how much lower. Now, what's next? Next thing is for us to, let me just jump forward here a bit, to look at the real interest rate. So we made an assumption about inflation, and we've also made an assumption about the bank margin, but what will the real interest rate be? Now, this is an important question, and for this purpose, we should come back to this slide here and have a look at this slide. Let me just jump back a bit. Okay, what we've got in this slide is the cash rate. I borrowed this slide from the RBA. So the red line is the RBA's cash rate. At the moment, it's 4.35%. We're not making this video in August of 2024. So at the moment, it's 4.35%. Now, what is the real interest rate? So real means that we take inflation out. So if we take our 4.35% cash rate and subtract out the inflation rate at the moment, this is the core inflation rate, 3.9%. And so once we take inflation out, then we're down to the real interest rate. So that's what the blue line is, the real interest rate. So to get to the actual interest rate, you would start with the real interest rate and add inflation. So to get to the mortgage rate, start with the real interest rate, add inflation, add the bank spread. So if we come back here to before COVID, I should say before the GFC, then the real interest rate was about 2.5%. So to get to the cash rate, you'd start at 2.5%, add inflation, say that's 2.5%, so now you're on 5%, add 2% for the bank's margin, now you're on 7% to get to the mortgage rate. But then, if we move forward to not the pre-GFC period, but the pre-COVID period in here, real interest rates had fallen in Australia and around the world to 0. So in this period, to get to the mortgage rate, start at 0, add inflation, let's say 2.5%, add the bank spread, 2%. So now you're on 4.5%. So it's really crucial in thinking about their investment journey after the inflationary impulse of COVID, where we had all of that creating of new money, quantitative easing, we had all of that government spending to help to control the economic effects of COVID. After that passes into the rear vision mirror, let's say in a year's time, where do we go back to? Do we go back to the pre-COVID conditions of low interest rates or real interest rates, or the pre-GFC condition? Now, a lot of good economists, such as Larry Summers or Charles Goodhart, they think we go back here. Now, I think, and lots of other economists, think that we go back here. Now, why I think this and other people think that and who's right, let's talk about that in another webinar. But this is a crucial assumption. And that's what I'm trying to bring out here. And it's a source of risk. We don't know whether we're going back to here and lower returns or back to here and higher returns. This is about the cost of the money that you're borrowing, the cost above inflation. And we can see it here. Now, you can see that I've chosen in our example something in between the two. But what if it turns out that we go back to 0 interest rates, to 0 real interest rates? What if we go back to here, pre-COVID conditions? Then their return will be higher. Their real after-tax return will be a lot higher. What if we go back instead to the pre-GFC conditions? Then their real return will be a lot lower, but it won't be that low. It'll still be 6%. You know, there's a lot of gravy up here, but it's not that bad down here. It's still better than putting money into super, for instance, in our expectation. And so this is a very important assumption But even with strong assumptions as to what happens to real interest rates, we still get to acceptable levels of returns. We'd much rather be up here, and it's quite possible that they do end up here. Okay, we're trying to make realistic assumptions and see how good the negative gearing strategy is going to be. Now, another one is about net rental yield. So let's say that land tax goes up and their net rental yield is lower at 1.2% instead of 1.5%. That will have an effect on their real after-tax returns. It'll definitely drive it down. It is sensitive. Their return is going to be sensitive to this. But they're still going to end up with good returns. Not so sensitive that, I guess the conclusion from this is that there's quite naturally very great concern amongst investors about land tax, increases in land tax, and that will crimp net rental yields. It won't affect the other parts of our analysis. It will crimp their net rental yields. But realistic assumptions about what could happen to land tax, even in Victoria, which is facing quite a difficult budget situation, shouldn't put investors off negative gearing. Realistic assumptions mean that they still get to good returns. That's what I'm trying to bring out here. Okay, sensitivity to net rental yield, and especially thinking about land tax. And then what about income tax rates? So our couple are now down here because their careers have moved on and they're making lots of money. But what if they were at lower levels of income? Does negative gearing still work for people at these lower levels? Well, yes, it does. Here we can see the returns at lower levels of tax. It's not correct to say that negative gearing only works for people on the highest tax level. Certainly it works better for them because it's a tax strategy, a strategy of turning pre-tax income into after-tax capital gains. And that tax strategy works better at higher levels of income tax, but it still works perfectly fine for lower levels of income. Getting close to the end here, and so let me just remind you that negative gearing's got a lot going for it, and we'll come to some other factors in just a moment. But just as a tax strategy, it's a strategy of turning pre-tax income into post-tax capital gain. And that means that you've got to go for growth. It's about growth. It's about giving up income to get growth, pre-tax income to get capital gains, which are taxed at a lower rate. That's what negative gearing is as a tax strategy. Now, it's got other good things going for it, but as a tax strategy, that's what it is. It turns pre-tax income into capital gains. People aren't clear enough about that in their thinking, and it means they don't go enough for growth. They don't focus enough on growth. Here's the notion that we put money out here, pre-tax money, pre-income tax money, goes out to support the negative gearing property. Let's say 20,000 goes out here. And if we just turn $20,000 into $20,000 of capital gains, then the capital gains discount means that only half of the capital gains will be taxed, whereas the other half will be untaxed. So if we let $20,000 flow through, instead of going into the negative gearing strategy, it would be fully taxed, and after 47% is taken out, we'd have $10,600. But if instead we put it into negative gearing and it gets turned into capital gains, only half will be taxed, and the other half won't be taxed. And instead, we'll have $15,300. This is the essence of the tax nature of negative gearing. Now, negative gearing is good on these dimensions. You can achieve high leverage early in your investment journey. And if you want to be a long way to the right on the risk spectrum, because that matches your investment circumstances, then high leverage early in your investment journey is great. And negative gearing is the way to get there. It's borrowing against property is both lower risk and a lower cost of borrowing than borrowing against anything else. You can get to high price growth, which is so essential for negative gearing, if you have a growth strategy in your negative gearing, if you really focus on going where there's growth. And negative gearing, of course, as a tax strategy, is turning pre-tax income into capital gains. So what are the most essential things to focus on in negative gearing? Maintaining leverage and refinancing to reestablish the leverage and using the equity somewhere else in your investment portfolio. Either use it to buy another property or perhaps lending the money into a family trust, strategies that we talk about on my investment course, and going for growth. It's negative gearing isn't about going for income, like apartments and houses in regional properties, in regional areas. It's about going for growth, going for properties that are hard to replicate, like houses in leafy suburbs, and also going for parts of the property market where there's more interest from global investors, which will help to drive growth. Something, again, that we talk about in my investments course, amongst many other things. So I hope this has helped. I hope that you now have a better understanding of what are the drivers of negative gearing and the sensitivity of negative gearing to things like real interest rates, to real price growth, to inflation, to the rental yield, etc. I hope this has given you a deeper understanding and to be able to put together a better strategy. Don't forget about my investments course, which you can find at windlestone.com.au, and you can email us to get more information as well. Thanks for attending. See you in the next webinar.